overall,
thank you.
Earnings have been quite good so far. Are you optimistic that we're not going to see worst case scenario for the economy?
We are, and we have been for a long time. We think that all of the major economies will avoid recession. We're talking about weak growth below trend, but we don't think recessions are likely across the US, Europe, or most other major economies. And for that reason, we don't expect earnings to collapse, but we do think that earnings are going to be pretty pedestrian over the course of this year. So it's a balance of modest growth, but positive, and not much going on in terms of corporate profits, we think, overall.
Pretty pedestrian in terms of the picture for equities. When you zero in, Peter,
yes,
on the tech story, and we have a reporting, a Bloomberg piece today on the upside that we've seen, particularly in the IT index over in the S&P in the US, up 19% so far year to date. Does the tech rally look overdone to you at this point?
Well, I think that I would say two things here. First of all, the tech rally in part, of course, has reflected this big shift down in interest rate expectations as investors get more optimistic that with inflation peaking and coming down, interest rate cuts are not far away. We think the optimism about interest rate cuts is premature. For that reason, I think there will be some constraints on tech moving forwards. But the second point, I think, to emphasize is that big tech is relatively defensive. You've got strong balance sheet companies, highly cash generative, with relatively stable growth. And that's the characteristics that people have been hankering for in what's been a relatively uncertain environment, both for the economy and for inflation. And it's for that reason, not only big tech has been doing well, but other strong balance sheet, stable margin, defensive parts of the market have also prospered in other markets as well. And we continue to like those.
So, Peter, when you look at big tech, is it less about implications from inflation normalization and more actually about what happens with AI and how it could displace a lot of these big tech companies in 3-4 years?
Well, of course, the history of technology has always been about innovation, and very large cap tech companies have not typically remained the fastest growing over time as new technologies come through and innovation generates new leaders. That being said, of course, some of the big tech stocks at the moment, because they have so much cash, they're investing aggressively in these areas of new innovation, and some of them may well continue to be leaders in that area as well. So I think it's a bit of a balance here. Clearly, the drive in technology is shifting a little bit from what we were seeing over the last decade in particular, but it will create, I think, lots of opportunities for tech companies and indeed for companies in industries outside of the tech sector, which can use that technology, AI and others, to improve efficiency, productivity and margins. And we're looking for companies that can sustain and generate higher margins really on a sector neutral basis. We think a lot of the focus will be on margins moving forwards rather than simply revenue growth, which was really the principal driver of return differentiation in the last few years as interest rates were very low.